This is May 11th, and with me today I have One America. I have Jeremy Verizer with us on the line. He's our Regional Marketing Director with One America. Jeremy, good morning. How are you doing today?
Hey, I'm doing well, Kathy. Thank you.
Wonderful. I'm glad you could join us this early Monday morning.
Absolutely.
Well, I'm glad we got you on the phone because a lot of agents have been calling in and asking us about different type of planning that we can do for hybrid type products for long-term care or accelerated products. And I know that's kind of your vehicle that you've been running with One America. So kind of tell us what's been going on in your world over there.
Sure. I've been with the company here going into my 9th year, so it's been a very unique time because we've seen what once was maybe considered somewhat of a niche product become really, I think many would argue, the forefront of long-term care planning, if you will. And really that's the goal here is we all know that we've got something like 10,000 people a day, turning 65 and retiring, just a huge wave of baby boomers. And the scary reality is that most of them, either by the time they look at long-term care, quote-unquote, insurance, they're either uninsurable or it's become too pricey, or they just don't like the idea of paying into something that's gone if they don't use it, that could have premiums that increase substantially on them throughout their lifetime. So the vast majority of the population really is self-insuring at this point in time. And so we've been it's been a perfect storm for us. It's just been right place, right time, right product, right story to tell your clients. And, the ability to come in and say, you know what, if you have a lump sum, you can reposition it. If you don't have a lump sum, we have monthly premiums or quarterly premiums or fixed premiums. So we really are there for really any of the clients that you might have that at least recognize that care may be a risk to their loved ones and their portfolio. And really, I'd argue today on this call for all the agents as well that this not only protects the client, but it protects the assets that are under the agent's management from being depleted. So from a 10,000-foot sort of standpoint, that's kind of what's been going on. The ability for us to say, if you don't use it, you don't lose it. If you need it, there's cash value. If you need to pay premiums, everything is fixed and guaranteed. It's just been a great story to tell, Kathy.
Wonderful, wonderful. Can you give us some information, just some brief information about the age group of the clients here?
Sure. And just to reiterate, because I think there is a large misconception in this industry that these asset-based policies, if you will, you might hear them called linked benefit or hybrids as well, but I think there's a big misconception that a lot of people assume that this is only for the wealthy client with a big chunk of change. And again, we offer the ability for somebody on these life-based LTC policies to pay a monthly premium, a quarterly premium, an annual premium. So, ultimately, when you look at that, somebody who doesn't have that lump sum, they're probably going to be more geared towards your younger ages, your 45, 50, 55, 60, the type of folks that maybe recognize that there's a risk. Maybe they had a recent experience with a family member, but they don't have a lump sum that they feel comfortable saying, I don't need this for income. So your younger ages tend to pay more of an ongoing premium type policy. Now, we will issue policies all the way up through a joint equal age of 80. So we see a lot of our lump sum come from that 60 to 80 age range. So I guess in a nutshell, really, anybody from 40 to 80 is definitely a candidate. How they fund it, is up to them and the agent, of course, for what works best. Now, if you come with a lump sum, the underwriting is going to be less stringent, as simple as a phone interview, actually. Whereas if you're paying the annual premium, that's obviously the highest risk or monthly premium to the company. So, there's a number of factors that go into that, but that's when, obviously, some of the value you and Premier provide, of course, among many other things, is you're going to know when you submit business with Premier, you're going to have a pretty good idea of what the underwriting process is going to be. So not to get off on a different tangent there, but age range really 40 to 80. It's just about how they want to fund it.
Wonderful. And I know there's different ways. Like you said, you can do monthly, quarterly, something like that. But if they have a lump sum, where can they bring this money from to do this besides like seed money? But can you explain that?
You got it. And that's probably one of the reasons we're having this call today is there are a number of other companies, and we've seen a huge boost in life policies that offer some sort of long-term care benefit, whether it's a a chronic illness rider or a true hybrid 7702B policy, we've seen a huge increase because I think a lot of the companies, are seeing the writing on the wall. And when you look at it, in 2002, there was an article in Morningstar Advisor that in 2002, there was 111 companies that were offering long-term care insurance. In 2009, I don't know why they say it was estimated. I'm surprised they don't have the numbers, but they say it was estimated there was 12 left. I think many of the folks on the call, if they're still offering long-term care insurance, which is definitely right for the right client, just that client base has shrunk because of the changes we've had recently in that sector. But the point is, most of these policies, these companies have backed away or completely got out of the LTCI market and have entered into some sort of life-based LTC policy. Well, one of the things that makes us unique is that we don't just have sort of a cookie cutter product, here's how it works, take it or leave it. We say, you know what? We're not just going to accept lump sums. We'll take an ongoing premium. We're not just going to take cash. We'll take qualified dollars. We'll take annuities, and we'll work with that internally. So really, we will take just about any type of money that incoming in, and a trust can own the policy as well. So really, you're not limited to any type of policy. The only thing we're really not set up to take is Roth dollars. So, either the client's owned it for 5 years or they're over 59.5 or whatever. And so then they would just liquidate and then put the cash in. But qualified dollars, cash, ongoing premiums, if anybody's on the call and they don't like the idea of repositioning a lump sum, they could create an income stream. Maybe the client has an annuity, kicks the income stream on, takes a portion of that income stream, sets up a 10 pay with us or a 20 pay or a ongoing continuous pay. So really, we are not limited, Kathy, to just cash or non-qualified dollars.
Wonderful. The title of our show today is Protect Your Clients and Your Assets Under Management. Can you kind of explain that a little bit to some of these agents, what that actually means?
Sure. Well, let's take it from a two-pronged standpoint. Let's talk about the client and their family first. We've found that probably the worst way to present a long-term care plan or solution, if you will, which doesn't necessarily mean our product at all, just the fact that if the client or clients were to need care, we know where we're going to go, and the family knows where we're going to go. Well, we found probably the worst way to present it is just to spit out a bunch of statistics. Hey, here's the average age somebody needs care. Here's how long it is. Averages are averages, which is just really just the difference between two extremes. The point is, we don't know how much care you're going to need, I'm going to need, the next person's going to need. So we better have a plan in place for the catastrophic risk. But what's nice is the plan that we can create here at One America does double duty, that if we don't need the care, like we hope we don't, if we just go in our sleep, it also has benefits for our heirs. So that being said, the first prong really is protecting your clients. Well, many would argue that the best way that they've found to present these solutions is to not take the statistical approach, but to say, you know what, Mr. or Mrs. Client, you may never need care, but if you did, how would it affect the people around you? More like a life insurance sale. It's the same reason why people buy term insurance when they get married, when they have kids. The statistical chance of one dying during their working years is very low, but the risk that my wife, for example, would have to take the mortgage on, kids' college funding, if I don't have a plan in place, is just too much for me to bear, so I purchase insurance to cover that. Well, this is the same type of concept, If I don't have a plan, then it means that my loved ones around me are going to have to scramble and decide, what are we going to do? Dad needs care, what pocket of money are we pulling from, if there's even a plan for it, who's going to check in on them, etc. So the first prong is to protect your clients, right? And I know that in this industry, for those folks that tend to, or that want to be in this industry for years to come, there's a lot of folks, unfortunately, when the money passes down to the next generation, that don't keep those assets. Well, creating a long-term care plan, what we found is it helps to keep those assets with that same agent or advisor, because the kids see what a good job they did protecting that risk, and they're very grateful for it. So the first prong, again, is the client. The second is, again, for people who tend to be, or who want to be in this industry for years to come. If you have no plan in place, I'll just grow the money and we'll just use it when we need it. Well, if the client gets a Ronald Reagan bout with dementia and needs 8 years of care, that's potentially $1 million plus that they're going to be depleting from the assets under that agent's management. And some of those assets may be paying residuals or whatever. And then the family sees that that risk wasn't protected. The kids get upset, money that should have gone to them went all to care. So to have a policy put in place is definitely going to take that two-pronged approach. And some of the unique things that we do at One America, in addition to the fact that we'll accept virtually any type of premium, is we actually have a U.S. patent on a joint policy. So we're the only life-based policy out there that can accept anybody with an insurable interest. So although we see most of it as husband and wife, a lot of the business can come from business partners, same-sex couples, brother, sister, mother, daughter, etc. And we also have a lifetime rider. So that lifetime rider, we're the only A+ rated or A-rated for that matter company out there that I'm aware of to have an unlimited LTC benefits rider. So for you and your practice, if the client needs that 8 years of care, they have a benefit that neither the husband or the wife can outlive, which thus in turn, of course, protects all of your assets under management. So long-winded answer there, but that is sort of the two-pronged approach I think that we're trying to summarize up today, Kathy.
Right. Hey, I like that answer, because inside your information that you just talked about, business partners, a lot of people don't think about them as a like a partnership that they would use this type of plan. So that opens the door for more sales for anybody to start talking to people who own a business together. And there's a lot of business partners out there that do that, and they don't realize this is a fantastic way to do a sale. Yep.
And you bring up a good point, Kathy, in that, a lot of people used to write like a traditional long-term care insurance policy on like a 10-pay or a 15-pay, and the business would peel off excess income and pay that premium and get the deduction or write-off. Well, to my knowledge, most long-term care policies out there that are still left out there today no longer offer limited pay options. They're just all continuous pay. So that strategy has not been an option for folks until they look at this policy now and they can do like a 10-pay.
Now, can you turn around and use this as some type of a key man insurance too?
You can, yep. Either we usually see it set up as either a key employee or an executive bonus. So
that's a good bonus for someone who's not a, being able to afford their own long-term care down the road or something. Even a life
well, the beautiful thing is the company can be the owner and the beneficiary. So if, they can kind of use it as the carrot at the end of the stick as another benefit. So when the employee retires, then they can change the ownership over to the employee.
Nice. And we also talked about spouses, but you guys have a feature which is really nice, a second to die option.
We do, yeah. It's actually a U.S. patent, which is kind of rare in this industry, as you among, of all people know, that's not something that's very common. So people say, well, that's pretty cool. Tell me about that. What's the advantage? Well, there's a number of advantages to having a joint policy. Number one, from an underwriting standpoint, a second to die policy, we can be more lenient on what we will accept than any other company out there who would have to write one policy. Let's take a husband and wife, for example. One policy on the husband, one on the wife. Well, now that's a single death, so maybe his risk is more of a heart attack or something. That company's still going to be a little weary because he dies, they pay the death benefit out. Here, it's a second to die. He dies of a heart attack, we still don't have to pay the death benefit out until a second death. So from an underwriting standpoint, what I'm not saying is we'll take somebody that's uninsurable. What I am saying is we'll take people that maybe would have had a tougher time getting an individual policy. So underwriting is more lenient. And then, Kathy, in your world with life insurance, as you know, a second to die, of course, has substantially less of an internal cost of insurance than two individual policies would have. Right. Which in turn, cheaper, which what does that mean for the client? It means with the same dollars that would have took me to get a policy on my wife and on me, we can combine those dollars, get a joint policy, and we can get a better benefit with the same dollars. So when you take, any other company out there that offers a life LTC policy, and you run a One America quote with Kathy at Premier on this, let's say husband and wife, we are going to be able to give a larger monthly benefit and make it last for life, which you won't find anywhere else out there.
Nice. Very nice. In today's age, a lot of people are doing estate planning. This is a perfect opportunity to add this to any type of estate planner that's out there. Any package, anytime you see a husband and wife, great opportunity to bring this up with them.
Absolutely. Yep. They love that idea because you really think, what are the two things that retirees are most concerned about? Number one on their list is always, did I save enough? Am I going to run out of money, right?
Right.
Number two is an unexpected medical expense. They may not say long-term care, but they're going to say an unexpected health issue, because if I get really sick, that can directly affect how my wife now has to live.
Oh, exactly.
So the estate planners love that, because it takes one of the two big concerns and addresses it.
Wonderful. I know we've had a lot of agents call us directly, and they do a traditional long-term care plan, and they do life, and they see a lot of things changing. And one of the biggest things they keep on asking is, what's the main difference between an acceleration and between something like this? But on this plan, it's not a true acceleration, correct? It's
correct. So in acceleration, here's the way that I look at it. So we were the very first company to design and market this product in 1988. At that point, we didn't get the HIPAA tax benefits till 1996. So at that point, we were purely just letting people, accelerate their death benefit plus have coverage behind it at a cheap cost. Now, like I said, you've seen a lot of companies jump in, and it's good. I mean, we want more and more companies. Shoot, we want Snoopy to do a commercial, and create awareness. We want more competition. It's a good thing. But the waters have become very murky, because you have chronic illness riders, which are not allowed to be marketed as long-term care insurance. They're not allowed to be sold as long-term care insurance. You do not need a long-term care license to sell them. And I think it's just a lawsuit waiting to come, because somebody out there is going to tell their client it's long-term care coverage, and then the client's going to have a stroke, go to file a claim, and find out that that only pays out if the need is permanent, not just for the 2 of 6 ADL. So a true hybrid policy, which is what we are, has to offer two things to be considered true hybrid long-term care and be considered or marketed as long-term care. Number one, it must offer coverage beyond the death benefit. So an acceleration is a great way for somebody whose their primary concern, and I know I'm preaching to the choir here with you, Kathy, but their primary concern is death benefit, is wealth transfer. And for a cheap cost or no cost, little cost, you can add on a long-term care accelerated rider. Not a bad deal for the right client.
right.
However, if the true concern is care, death benefit is secondary, right? People like the idea of, if I don't use it, I don't lose it. But death benefit is secondary, then we are going to show a better benefit. And not only do we allow them to excel their death benefit first, we offer the ability, again, to have a rider behind it. So we can either have that rider be a certain pool, or we can have that rider be unlimited lifetime. So that's one of the things it must offer, is a benefit option beyond the death benefit, which an accelerated rider wouldn't. Use the death benefit, it's gone. Done, policy's done. The other thing it must offer, in order to be HIPAA qualified and be marketed as long-term care insurance, is it must offer an inflation option. And so we do have options to tack on inflation. You can tack on inflation on the base policy, which is really where you accelerate your death benefit, or you can tack on inflation on the rider. Or what many folks do is they don't put it on the base policy, they put it on the rider, because it's much more affordable to do it that way. And that basically addresses the catastrophic risk, because once I deplete my death benefit, I bump into the rider, and that rider's been compounding by whatever my inflation has been, and that lasts for life. So it's the true catastrophic coverage. So hopefully that kind of answers your question. But with us, it's not just accelerating the death benefit, it's offering inflation option and riders beyond the death benefit.
That did a good job of that. What about receipts? Do you have to show receipts for claims? How does that work?
Yeah, so you're going to find most of the policies out there, and again, folks, this is why you call Kathy, because this stuff changes all the time. But most of these true hybrid policies that I'm aware of are what we call reimbursement. I know there are some life-based policies out there that offer indemnity. Indemnities where, to my knowledge, you still have to show some sort of receipt each month, but they're going to pay out the full benefit. With us, we're just going to pay out. So if your monthly benefit's $8,000 a month, you only start in the home and you only need $2,000, then you're only going to use $2,000, which means your death benefit lasts longer. But the point being, what most folks are doing these days is when they go to file claim, we require a plan for care, which is done by a care provider. So if that's in-home, assisted living, hospice, nursing home, it doesn't matter. But they will typically charge us directly for the client. So the client and their family are not having to keep receipts and print bills. The company is billing us directly. So yes, the answer is yes, we do need a receipt, but it's typically nothing the client or their family has to do. Usually the care provider is working with us directly to bill us.
Wonderful. But they can do this at home too, have at-home health care coming in?
All day long,
too?
Yep.
Okay.
Yep, the qualifications to meet it are no different than any other policy that is HIPAA qualified. And I keep saying HIPAA qualified. That's the law from 1996 that allows for long-term care insurance to come out tax-free from life policies, among other things. It did other things as well. But the point is, in order to be considered HIPAA qualified, the client would have to meet one of two conditions. Either they can't perform 2 of the 6 activities of daily living, or, and this is the scary thing that's happening more and more, they have a cognitive impairment like dementia or Alzheimer's that requires that they need some supervision. It's a serious cognitive impairment. So as long as they meet that, if they want to have somebody in their home for the rest of their life, we're good with that. So in-home, assisted living, hospice, nursing home, the whole gamut.
Wonderful, nice. So if you were talking to a brand new agent that wanted to get started in doing this, is there certain questions that you could help them with that would actually, things they could ask their own clients?
Sure. You know, I would start with those 2 questions. What I will say is this is not going to be a commodity type sale. So typically this involves or requires some sort of relationship with that client. But it's a good second sell behind your first sell. So if your first sell was talking to them about creating an income stream or saving or something, you know, this is a good tack on. Hey, by the way, you know, we got a lot of folks retiring. Medicaid system, which is the government's welfare program for care, is being very stressed, and you don't really want to go on that anyways. Let's create a plan, just God forbid, in case one of y'all does need care. And if you don't, guess what? There's newer policies these days where it doubles as a cash value you can access while you're living, and also doubles as a death benefit for your heirs. But if you need care, there's an unlimited tax-free benefit neither of you can outlive. So I would start with the 2 questions, and Kathy, I'll send you some of this information after we're done, and you can distribute to your agents if you choose. But I do have a 1-pager that summarizes these 2 questions. And again, those 2 questions, the best way to start is, hey, you may never need care, Mr. or Mrs. Client, but if you did, how would it affect the people around you? You know, that's the conversation starters. You know, we all hope we don't. But if we do and we don't have a plan, it's going to be kind of really stressful and emotionally devastating to our loved ones. So let's put a plan in place just in case. And if you did need care, what asset would you tap first? And that'll help direct you towards the money that may be either repositioned or may be able to create an income stream for an ongoing premium.
Those are very good questions to be asking clients. Okay, another information here on license. What does the agent have to have for a license or training to be able to sell your products?
Yep. So because it is considered true HIPAA qualified LTCI insurance, and we do have annuity-based policies as well, which I know we're not really focusing on this call, but you know, it's nice that we do have a full portfolio. And by far our most popular option right now, given the low interest rate environment, is this life-based policies. If if the client has both options, the life-based policy is the way to go. But the point being, because it does have a HIPAA qualified long-term care component, you do need your life license, life and health, and then you also need, if your state requires it, a long-term care cert. A lot of them are just 8 hours. You can take them online, 8 CE hours. Doesn't take you 8 hours, might take you 2. And it counts towards the 24, whatever your state requires that you have every 2 years. So kind of kills 2 birds with 1 stone. And then every 2 years there's just 5 hours of continuing or whatever. Every state's different, but for generally speaking, that's what a lot of the states are going by. So, but some of you on this call may be in a state like Wyoming, for example, that still does not require an LTC cert. So check with Kathy and her team, and they'll let you know, but that's ever changing as well.
Is there a certain state that you guys are not located in?
There is one. There is one state we are not located in because we do not have a separate branch of our company to accommodate that state, which is New York, unfortunately.
Okay.
We are in all of the other 49 states. What's that?
Wonderful. So that is a hard state.
Yeah. You get your challenging ones, and then you have other states that take some time to approve things. But we have, again, had this policy for a long time, so we are up and running in 49 of the 50 states.
Okay. Well, I got a couple questions here from some agents that are coming in right away. Someone, Ron is asking, can this be sold over the phone? Is there an electronic app?
There is an e-app, yes. There is an IGO, and I know you guys use IGO, and I know we've set it up there at Premier. So there is an IGO app where the client can e-sign. So, literally you can email, they can sign, etc. As for whether you can sell it over the phone, I think you'd have to check, just double check in your state, make sure, sometimes with the certain tax laws, you've got to actually see the client in person. So check with your state and all that just to be sure. I'm not super well versed on every state throughout the country, but absolutely you can do an e-app. You can email it to them, they can e-sign, and then they can send it back to you, I believe, Kathy, at Premier, and you guys can scrub it before sending it.
Okay, wonderful. Charles is asking, are long-term care charges in the policy guaranteed?
Absolutely, 100%. So the only charge that we have in the policy itself is the cost of insurance, like any other whole life chassis would have. And we do use a whole life with a guaranteed credited interest rate minimum of 4%, which is what we're at today, which probably isn't too much of a shocker given the 10-year treasury. But those, when you run an illustration and you work with Kathy on presenting this case, the numbers that you see in the illustration assume the highest cost of insurance. The cost for the rider to add an extension to benefits rider, that can be either an ongoing premium, a separate ongoing premium, which a lot of people like because that rider, so let's say you reposition $100,000 with your client and then you pay $2,000 a year to have lifetime benefits. That $2,000 a year is considered true HIPAA qualified LTCI insurance because that $2,000, it doesn't build life insurance cash value, it doesn't build death benefit, right? It pays for lifetime LTC coverage. So what I'm telling you is that the IRS considers that HIPAA qualified LTCI insurance, so one could deduct that premium just as they would a traditional LTCI premium. It's not an itemized expense, it's just a standard deduction that you get based on your age. There's a table, the older you are, the more you get to deduct. So a lot of people like paying it that way. But if you had a client who said, look, I just want to reposition $100,000 and be done with it, we could also say, you know what, okay, let's take $20,000, pay for the rider, the other $80 goes into the base and be fully done and paid up. The downside to that is you'd only get to deduct a small portion of that $20,000 that first year, and then you wouldn't get to deduct any more. So hopefully that makes sense. Does that make sense, Kathy?
Made sense to me, but I'm sure we'll have questions.
Sure.
You can call and reach us.
Yeah, you kind of got to run an illustration, really.
Yeah, and see that. Which is nice about that, when we run illustrations, we also do have like a risk assessment program. You guys have a form, a special form that they can fill out, and then we send it in to you guys to make sure and see that they would even pass underwriting first. Is that correct?
That is correct. I mean, there's things we're still not going to do, as no other company with a true HIPAA LTC benefit will do. I mean, we just can't take people that are already in care facilities. We can't take folks that are on oxygen, that are in a wheelchair, that have AIDS or Parkinson's. Those are some things that we just can't do. However, we have done things because, again, especially if you're there just going to reposition a lump asset, the risk to us is a lot less when somebody says, oh, let's reposition this 100. We'll use our 100 first, then we'll use your money after. So we've done things like rheumatoid arthritis, insulin-dependent diabetics, things like that that traditional policies typically wouldn't approve. Even cancer, as long as they've been clear for 2 to 3 years, a lot of companies ask for 5 to 10. So, we definitely have the ability where I would highly encourage you, anytime you have a client or clients with health issues, work with Kathy, and we have what we call a pre-screen quick quote. And you put down as much detailed information about their health as possible. It's only as good as what you're writing down. So the more accurate you are, hey, my client takes this med this much this often, had a stroke 3 years ago, here's what happened there. The more accurate we are, then the underwriter will come back and let you know based on what the agent wrote, whether they would be a candidate for our policy or not. And if they would they be likely to have a rating? Would it require full underwriting, et cetera? And we do go up to a table 8, Kathy, which is very unique in the industry as well.
Wonderful. That's nice. Elliot just asked, what are the underwriting categories?
Yep. So there's standard and preferred, and we're a little different than what most people think. The only time you're ever standard with us is if you're a tobacco user, specifically a smoker, actually. So otherwise, everybody else is preferred. Then you could be preferred up to a table 8 of 8. From table 5 and below, you're just preferred as applied for. You get the same rate as somebody who has 0 health issues. If you're table 6 of 8, obviously it's either going to take more premium to get that, or your benefit will be less, and the same is true for 7 of 8 and 8 of 8. And so that's another advantage of having a joint policy, really, if you think about it, is if I've got some health issues, my wife's healthy, by doing a joint policy, I'm going to get way better benefits for myself than I would ever get on my own.
Nice. Okay. And like you said, smoker is just basically considered standard, so that's really nice too.
Yep.
Wonderful.
Yep.
Okay. One question out here, farmers.
Yes.
A lot of people, have farmers, they got their kids taking over the land, and a lot of them really don't perceive themselves because they think they have enough assets. But can you explain why this would be a good fit and a good vehicle for them to be using?
Sure. Well, I'll give you one example right away. Is a lot of these farmers, and I'm in Colorado, and I've been out to see you guys out there, and so we have a lot of farmers through the states that I've been to and live in, and you guys are in, and a lot of these farmers, one thing they neglect to really explore until it's too late sometimes is the fact that care providers aren't a dime a dozen out there. So a lot of times, we've seen situations, unfortunately, where the kids had to send mom or dad 2-3 hours away to the closest city that could provide, full-time round-the-clock care. Well, if I set up one of these plans, I can literally hire like a live-in care provider. So I can hire somebody that's actually going to come out. I can stay on my farm. I can stay around the kids, and they can be with me around the clock. Because again, as long as I meet the 2 of 6 or the cognitive impairment, we don't care if you're in your home the whole time.
Nice. I have another question here from Elliot. Insurable interest. Can sisters in their 60s be in a joint policy? Or how
Absolutely.
Does that work?
Yep. Sisters all day long, brothers, mother, daughter. There's a couple of stipulations we require. Number one, the age difference cannot exceed 25 years. So unfortunately, dad can't be 95, and have a wife that's 40, or can't get on the policy with the daughter or the son. 2 sisters in their 60s, no problem at all.
I can see them being used all the time now, just because so many people do, if mom and dad are gone, it's like who they have, or they no longer have a spouse anymore, and the older they get, this would be a perfect opportunity for them. Okay. And do they have to be, on an S survivorship, do they have to be married?
That's a great question. Absolutely not, actually. I've personally seen a case go through for boyfriend and girlfriend that lived together for 2 years. So if they are not married, we want to see some sort of relationship that has been established. Typically, they need to have at least lived together for a couple of years.
Okay.
And to be honest with you, I think most of the time you submit the app, we don't really question it. So,
nice.
But I would always be prepared to have a reasoning for why you're going into a joint policy if they have, if they're not married. Just be prepared for that.
Wonderful. Do you have marketing pieces, I know for us, for agents, but do you have selling pieces, brochures for clients that they can use?
I do, and we're constantly coming out with new ones. So again, another advantage to working with Kathy and Premier is, Kathy, I'll just keep feeding those to you as we get them, and you can distribute as you see fit, but I'll get you the email I'll send after. Not only will I attach some agent pieces from this call, I'll attach some client pieces. Now, we have a client brochure, but my problem with client brochures, whether it's our company or the next company, they're often long-winded and wordy. Let's face it, the client typically isn't going to read, 5 pages as much as we like to think they would. We have a mailer that is set up for this, and I don't necessarily see it being actually mailed out a lot, but I see it as a good handout to a client. So, for the agent, hey, you know what? here's something we haven't addressed. Take a look at this thing. I'll circle back with you here next week or in 2 weeks or whatever, and we'll have a conversation about getting maybe this addressed. It's just bullet points. It's real quick and to the point, and there's really no room for confusion. So it's very simple. But we do have one-pagers too that talk about the ability to pay ongoing premiums that are fixed and guaranteed, which has been a huge objection of traditional long-term care insurance lately. So I'll get all that stuff to you.
Wonderful. I appreciate that. And then another question again, do we have to be appointed to run illustrations? So your software is available on your website, correct? So you do have to be appointed. But
you do have to be appointed, yeah. And really the best way to do it is run it through Premier because, the illustration, if you just wanted a cookie cutter, plain Jane, here's the way it works. You use your money for 2 years, you get the company's money for another 2 years. There's plenty of companies out there that offer that type of policy. With us, we say what's important to you and your client in this situation, and we'll design the policy because we have so many different levers we can hit. And we're not going to send you, obviously Kathy's not going to send you 16 illustrations. She's going to talk to you, find out what's important to you and the client, run one, maybe two. So, but if you just tried to run them on your own, you might be a little overwhelmed at first by all the different options. So if you prefer to do that, then Kathy, you can work with your agents on that, but they do need to be appointed to get that software.
Wonderful. Wonderful. Well, thanks a lot, Jeremy. I think we're done with questions right now. If anyone has additional questions, please feel free to give us a call at Premier. Ask for a life marketer, and I know I actually sent this out incorrectly the first time, but it is 800-365-8208. And just call in and ask for a life marketer. One of us will be able to help you run options, get you some information, and as we start going through the day and start finding out what you send to us, Jeremy will be more than happy to start sending that information out to everybody that's on the phone right now or listening to us. Any other questions or anything you have for us, Jeremy, to close today?
No, not at all, other than, everybody on the call has already taken the first step to put them ahead of the competition, because as much as you and I would like to think that every agent and advisor is out there talking about this, it still has a lot of room to grow. So the fact that you folks are on the call now, I think, puts you ahead of the competition, and there is an enormous amount of people that need a plan that have either not even had it brought up by their agent or advisor or haven't thought about it yet. So I would just say we're all on the brink of what could be huge for everybody.
And I have one question to add to that. You just said a lot of people don't ask their clients that. Why do you think that is? Are they afraid to ask and bring this up, or what do you think that is about?
Well, let's face it, it's not exactly as exciting as talking to a client about, transferring wealth to grandkids or creating an income stream they can't outlive. I mean, it's not exactly a bright, sunny day that we want to talk about long-term care coverage potentially. But, a lot of times, stay away from the word long-term care, because a lot of people, they hear long-term care, they think nursing homes, they think premium. Just talk about what if you were to get sick later on in life. What if you needed some sort of extended care? And we find that helps bring that conversation up without being so, I guess, without those walls going up right away. And then the other reason, I think, besides the fact that it's not exactly the funnest thing to talk about all the time, is we're creatures of habit, and we do what we do, and we go back to our office, and we sell what we sell, and we talk about what we talk about. But we know in the back of our heads, and this is probably the reason why you and I, Kathy, get more and more calls each day from money managers, from financial planners who didn't write long-term care a year ago. These are people that now are starting to acknowledge the fact that this is a huge risk. So I think a lot of people don't talk about it because they're not comfortable with the conversation, not just from it's not exactly exciting, but a lot of people feel like they need to be the product experts. And what we see with successful agents and advisors is they realize they're the opportunity expert. All they got to do is start the conversation, give the client enough that they go, okay, yeah, let's talk about that. So I'll give you an example. Hey, Mr. and Mrs. Client, one of the things that we really haven't addressed, I know it's not the most happy sort of conversation, but if one of y'all were to get sick later on down the road, we need to have a plan in place for that, and there's some really unique opportunities out there today where we don't no longer have to buy like an insurance to purchase that. We can just reposition an asset where if you need it, it has a tax-free benefit for care that you'll never outlive for either one of you. While you're alive, it still is one of your assets, so you can liquidate it, loan against it, whatever. And if you don't need it, which we hope, it doubles his life insurance for your trust or your kids or your grandkids. I mean, that's enough to get somebody to go, what? What's the catch? Well, that sounds too good to be true. Well, that's the right path that we want to go down. Tell you what, let me reach out to the folks that I have that get these proposals, and we'll look at some starting points. And then that's when you call Kathy and Premier, and we get an idea of their ages, you know, who would their beneficiaries be, et cetera, and we'll run it based on that situation. So I think a lot of people, they just don't ask because they feel like they got to know everything about the product, and they don't. They just need to recognize the opportunity and let us be, Kathy and I, be the product experts.
Wonderful, wonderful. And one more question here, and we'll finish up for the day. But besides being appointed to run illustrations, do they have to be appointed to sell the plan? Can they do a contracting and application at the same time?
Depends on your state, and you know that, Kathy, too, based on the states. It just depends on your state if you're allowed to have a backdating. Some states allow 15 days or 30 days. Some states you have to be appointed the day you write, the minute you write it. Most states, though, will allow you to submit paperwork for appointment. But what I would encourage everybody on the phone to do is just so it's one less thing. I mean, I'll be completely honest with everybody here. We are very busy in our licensing department. We have a lot of people licensing with us. So the best thing to do is go ahead and get your appointment through Premier. We do not require a piece of business to get appointed. So the best thing to do is just go ahead and get your appointment through Premier done. And then that way when you write business, it's one less thing we got to wait on. So, but if it did come to the point, like if somebody's on the call, and what I would encourage everybody to do on this call, if you are thinking about any one of your clients, jot that down, call Premier, have a quote run. That's the best way to run this, or the best way to learn this policy. Even if it's a family member or you on yourself, run it. That's how you'll learn it. And whether you sell it or not, you know, no big deal, but that's the best way to learn it. But if somebody's on this call saying, I got a case I can write right now, just double check with Kathy and her team. And most states do allow you to submit the appointment paperwork with the app.
Right. And your website address again?
Yeah, probably the best one. So you can always go to oneamerica.com. And One America is an A+, AM Best rated. We're a 95 Comdex mutual company. Great story to tell, been around since the late 1800s. So we have a really good story to tell for the folks that say, who the heck is One America? Based out of Indianapolis, Indiana. If you're ever there for a Colts game or whatever, just look up. It's the second tallest building. The street's called One America Square. So very respectable company in that community. But the point is, you can always go to oneamerica.com, but we do a number of different businesses. So we're really big in the employee benefits business, for example. So if you want information on this specifically, the best website to go to is www.assetbasedltc.com. So that's all one word jumbled together, well, 3 words jumbled together like one word, no hyphens or dashes, assetbasedltc.com. And there's plenty of information. We do not directly appoint, so you do have to run your business through a BGA, and obviously you're on this call with Premier here. Premier is one of our top accounts, so I would personally encourage you to, if you're not already, get appointed through Premier because they know this stuff. They've been doing this for a while, you know, and we have a trusted relationship together. So go ahead and get appointed through Premier. Visit that website for more information. I'll send you, Kathy, some trailing documents you can distribute, and we should be good.
Appreciate it. Appreciate it. Thanks, everybody. Have a great day. If you have any questions, again, call 1-800-365-8208. Ask for a life marketer. Thanks, Jeremy. I appreciate your time, and we'll talk to you later, okay? Have a great day, everybody. Thanks. Bye.